Banks are a financial institution, and their purpose is to store, save, and loan out money. On a bank account chart, they have liabilities and assets. Under their liabilities, there are demand deposits, and under their assets, there are excess reserves and required reserves and loans. Required reserves are what a bank is supposed to hold from their demand deposit, and the excess reserves is what is left over that can be loaned out. To find how much a bank is supposed to hold back in their required reserves, there is the required reserve ratio. For example, $100 is deposited into a bank. It becomes the bank's demand deposits. When you multiply the demand deposits by the reserve required ratio, which is 0.20, you get $20, which equals your reserve requirement. When you subtract that reserve requirement from your demand deposit, you get your excess reserve, which equals $80. Under a single bank, the max that they can loan out would be their excess reserve. So after finding your RR by multiplying your demand deposit times your reserve requirement ratio and subtracting that from your original demand deposit, you get $80 left over, which is your ER. However, under a commercial banking system, the max that they can loan out is much greater due to the money multiplier. The money multiplier is 1 over the reserve requirement ratio. You multiply it to your excess reserves, and it gives you the max that a commercial banking system can loan out. So, to go with our example, after we have found our ER, which is our excess reserve, we multiply it times 1 over 0.20, which gives us $400. Not only do banks loan money to their customers, but also to each other. The federal fund rate is the interest rate that banks charge one another for overnight loans. Instead of a bank going to the Federal Reserve to take out a loan, which would have a higher interest rate, they would go to one another for a lower interest rate for a shorter period of time. The federal fund rate can increase or decrease depending on what the economy is experiencing, whether a recession or an inflation. 3 types of monetary policy can be applied in order to fix the economy when it is experiencing these things. The reserve requirement is the ratio set by the feds that requires banks to hold back a certain amount of money from their demands that are deposited. In a recession, the reserve requirement decreases, which causes for money supply to increase, interest rates to decrease, and aggregate demand to decrease. During inflation, reserve requirement is increased, which lowers money supply, increases interest rates, and lowers aggregate demand. Under the open market operation policy, the Fed buys or sells government bonds, which are securities. Buying government bonds increases the money supply in a recession, and selling government bonds decreases money supply in an inflation. The discount rate policy is the interest rate reserve banks charge commercial banks for short-term loans. This stimulates the economy by increasing or decreasing the demand for banks to take out loans and put money into circulation. In a recession, an easy money policy or expansionary policy is used. In an open market, bonds are bought, the reserve requirement decreases, the discount rate decreases, bank reserves increases, money supply increases, and the federal fund rate decreases. During inflation, tight money policy or contractionary policy is used. The open market sells bonds, the reserve requirement increases, discount rate decreases, bank reserves decreases, money supply decreases, and the federal fund rate increases. The policies can be used interchangeably to help with the fluctuation of the economy. Both Congress and the Fed play a role in improvising the use of fiscal policies and monetary policies to fix the economy. All of this correlates to the magic of money, not only on a citizen level, but on a government level as well. When a government buys or sells bonds, they have liabilities and assets, like when a normal person deposits or takes out money from the bank. So, if a government is in a recession and they buy $10 million in bonds in an open market and the reserve requirement ratio is 0.20, the money supply change in loans will increase in a banking system, and that would equal $40 million. To get the maximum change in loans in the banking system, we start off by using an account chart like we did with the normal bank. Our liabilities, which is our demand deposit, would be $10 million. We would multiply that $10 million by the reserve requirement ratio of 0.2 and get $2 million. Then subtracting the demand deposit of $10 million from our reserve requirement of $2 million, we get our excess reserve of $8 million. Because we're in the banking system, we have to multiply our excess reserve to our money multiplier. So when we multiply $8 million over 1 over 0.20, our multiplier, we get $40 million. The government increased the money supply of the economy by $40 million. Money creation and its stimulants, when enacted in an economy, can create an illusion of magic. But why go through all of that when you could just wish for it?